4 days. That is how long the silver market has to answer a question it has been dodging for years. Right now, sitting in COMEX vaults across the United States, there are roughly 89 million ounces of silver earmarked for delivery. The contracts demanding that metal total 429 million ounces. Those two numbers cannot coexist. And on February 27th, when first notice day arrives for the March delivery cycle, one of them has to blink. Silver closed this week at $87.73 per troy ounce. That number alone would have been unthinkable 12 months ago. But the number is not the story. The story is the architecture beneath it. A collision of physical scarcity, geopolitical resource warfare, and a paper pricing system that is being stress-tested to its structural limits. What you are watching unfold is not a commodity rally. It is a repricing of what silver actually means in the 21st century global economy. Consider this. In the span of 4 weeks, silver traveled a $57 range. It touched $121.67 on January 29th, shattering the Hunt brothers record that had stood since 1980. Within 30 hours, it cratered 47% to $64. Margin hikes, a hawkish Fed chair nomination, and forced liquidation of leveraged positions combined to produce one of the most violent sell-offs in commodity history. The financial press ran their obituaries. The narrative shifted to speculative excess. And then something happened that nobody on a trading desk expected. Every single wave of selling was absorbed by physical buyers. The metal that futures traders were dumping at $64, dealers were purchasing at $98. The disconnect between what a screen said silver was worth and what it cost to hold an ounce in your hand reached 54%. From that February low of $63.85, silver has climbed 37% in 17 days. Not on leverage, not on speculative positioning. Managed money net longs sit at a mere 5,172 contracts, a fraction of January's levels. This recovery has been driven by something far harder to reverse than a momentum trade. People and institutions who want the actual metal and a market that is running out of it. To understand why the next 4 days could redefine this market, you need to see how the architecture was built and where the cracks have been spreading for 6 consecutive years. COMEX is the beating heart of global precious metals pricing. It is the exchange where futures contracts set the benchmark. Miners, refiners, jewelers, and central banks reference it every single day. The system works on a simple premise. Most contracts never require physical delivery. Traders buy and sell paper claims on metal, settled in cash or rolled into the next month. The small percentage that actually demand metal has historically been manageable. The vaults hold enough, the system functions. That premise is fracturing. COMEX registered silver, inventory available for futures delivery, fell to 88.79 million ounces. This was after a single-day withdrawal of 3.36 million ounces on February 19th. This inventory has collapsed more than 80% from its 2021 peak. Since October 2025, holdings declined 38% from 167.7 million ounces. In one 7-day stretch during January 2026, 33.45 million ounces walked out. That is 26% of the deliverable stockpile, gone in a week. January deliveries alone totaled 49.4 million ounces, 7 times the January 2024 figure. The February delivery rate hit 98%, meaning virtually every contract demanded metal. Total vault holdings, including eligible inventory, sit near 369 million ounces. But that number is misleading. Eligible silver belongs to specific owners and is not offered for delivery. It cannot be commandeered. Only the shrinking 89 million ounces is contractually available. The March contract, with first notice day 4 days away, represents 429 million ounces. If this structural analysis interests you, please do me a favor and hit subscribe. Next, we'll explore the geopolitical dimension, transforming this from anomaly into something larger. The futures market is flashing a signal veterans watch closely: backwardation. The spot price of silver now exceeds the futures price. Normally, futures trade at a premium due to storage and financing costs. When inverted, buyers pay more for metal now than for a future promise. The market is saying, delivery today is worth more than delivery tomorrow. That is the signature of genuine physical tightness, deepening for weeks. On January 1st, 2026, Beijing did something that restructured the global silver supply chain overnight. China reclassified silver as a strategic material and imposed export licensing requirements so restrictive that they function as a near prohibition. Only 44 companies received approval to export silver during the 2026-2027 period, and each must demonstrate annual production capacity of at least 80 tons. This matters at a scale most analysts have not fully internalized, because China controls between 60 and 70% of the world's silver refining capacity. When Beijing restricts outflows from those facilities, it does not trim global supply at the margins. It structurally removes the majority of refined silver from international markets. The Shanghai Premium tells you everything you need to know about the result. Cash silver in Shanghai now trades at a 29% premium over Western spot prices. Factor in China's 13% VAT, and wholesale physical silver inside China commands a 45.8% premium over COMEX. Price dislocations of that magnitude do not appear in functioning markets. They appear when supply is being deliberately constrained while demand accelerates. And China's domestic demand is accelerating. Solar panel manufacturing, electronics production, electric vehicle components. China is simultaneously the world's largest manufacturer of the technologies that consume silver and the choke point for the refined metal those technologies require. And while China locks down supply, India is vacuuming up what remains. In 2025, India imported nearly 6,000 metric tons of silver, approximately 190 million ounces, representing a quarter of total global production absorbed by a single country. Indian silver imports surged 44% year-on-year to $9.2 billion. Silver ETF inflows in India nearly tripled. This is not merely cultural demand for jewelry. India's government has committed to 500 gigawatts of renewable energy by 2030, and silver is an essential input for the photovoltaic cells that Target requires. The Silver Institute estimates the 2026 supply deficit at 67 million ounces. The cumulative deficit from 2021 through 2025 totals 820 million ounces. Metal that has been consumed, processed, soldered into circuit boards and solar panels, and is never coming back to the market. 6 consecutive years of structural deficit. And the two largest forces on opposite sides of the supply equation, China restricting, India absorbing, are both intensifying. Everything you have just heard is the setup. The part they are not discussing on financial television is what happens when that math collides with the paper pricing system, and the evidence that collision is already underway. When COMEX futures crashed 47% in January, something revealed the fault line that runs beneath the entire silver market. Physical premiums did not follow the paper price down, they exploded upward. While screens showed silver at $64, the actual cost to acquire a physical ounce was closer to $98 to $100. Dealers refused to sell at the paper price. American Silver Eagles traded at $12.74 above spot. Canadian Maple Leafs showed 7 to 10 day fulfillment delays where normally there are none. Major bullion dealers reported wholesale inventories sold out across most products. The stress extended deeper into the institutional plumbing. Silver lease rates in London surged from a normal range of 0.3 to 0.5% to over 8% annualized. The Royal Canadian Mint saw lease rates spike past 100%, forcing production halts. Several U.S. refineries stopped purchasing scrap silver because processing became unprofitable at those financing costs. The exchange for physical spread, normally around 25 cents per ounce, blew past $1.10. On October 10, 2025, the London silver market seized entirely for 90 minutes due to liquidity exhaustion. The infrastructure that prices and delivers physical silver is under more strain than at any point in modern history. And this is where a question emerges that nobody in mainstream financial coverage is asking. If paper silver and physical silver are diverging this dramatically, which one is telling the truth about value? The LBMA vaults in London hold approximately 27,700 tons, but roughly 75% of that tonnage is locked in ETF allocations. The actual free float available to the market may be as low as 200 million ounces. Consider that against the context of SLV alone. The iShares Silver Trust, which closed at $76.62 on February 20th, with holdings exceeding 510 million ounces and a market cap of $42.5 billion. On January 27th, SLV trading volume nearly matched SPY, the most traded fund on Earth. Call option bets on SLV reached $40 billion, equivalent to roughly half the world's annual silver production. Here's the question that sits at the center of everything I have shown you. What happens to a pricing system built on the assumption that delivery is the exception when delivery becomes the rule? 429 million ounces of contractual claims, 89 million ounces of deliverable metal. The math resolves one way or another by Thursday. Drop your analysis in the comments. I read everyone, and some of the sharpest thinking on this channel comes from you. The mining equities tell the story of a market that has not caught up to reality. First, Majestic Silver posted record production of 15.4 million ounces in 2025, up 84% year over year. Hecla Mining reported all-in sustaining costs of $11 per ounce, while silver trades at $87, margins that are historically extraordinary. And yet, analyst price targets for these companies are still modeled on silver at $25 to $50. The street has not updated its assumptions. By the time it does, the repricing will already be mature. And this is where it stops being about vaults and contracts, because the forces driving this are not confined to the silver market. They are reshaping the monetary order itself. Zoom out far enough, and silver's crisis becomes a window into something much larger. The dollar index sits at 97.48, down 8.3% year over year. Gold trades above $500. The BRICS nations launched a gold-backed digital trade currency on October the 31st, 2025. Over 90% of trade between Russia, India, and China now reportedly occurs without dollars. Central bank gold holdings have exceeded Treasury holdings for the first time since the 1990s. The dollar's share of global reserves has fallen to a 32-year low. U.S. national debt stands at $38 trillion. These are not forecasts. These are current coordinates on a map that multiple governments are reading simultaneously, and each one is drawing the same conclusion about hard assets. The Supreme Court struck down the administration's sweeping tariff authority on February 20th, ruling the IEPA-based framework unconstitutional. A replacement 15% tariff was imposed within hours under different legal authority. But here is what matters. Silver and gold imports remain exempt, carved out under critical mineral classifications. More than that, the administration launched Project Vault, a $12 billion initiative to build a strategic mineral stockpile. Silver is on the list. The U.S. government is not merely exempting this metal from trade barriers. It is signaling that silver is a resource worth competing for at the national security level. Now, the honest counter case, because this channel does not deal in hype. Thin liquidity environments amplify moves in both directions. Shanghai reopens Tuesday after a closure, and Monday's trade will occur on a thinner tape. The bullion banks have navigated COMEX delivery crunches before through cash settlements, emergency metal sourcing, and position rollovers. The system has shock absorbers, and dismissing their capacity would be intellectually dishonest. The 54% physical premium is a stress indicator, not a permanent condition. It can compress if spot rises to meet physical prices or if demand softens. And a genuine global recession would hit silver's industrial demand, which accounts for over half of consumption. Being right about the direction and right about the timing are different skills, and confusing them is how correct theses still produce losses. But weigh those risks against the structural picture. 6 consecutive years of supply deficits, 820 million ounces of cumulative shortfall, the world's largest refiner restricting exports, the world's hungriest importer accelerating purchases, a paper pricing system whose core assumption that delivery stays, the exception is being challenged by the hardest evidence available, the actual behavior of contract holders demanding metal. The gold to silver ratio at 59.5 to 1 still has historical room to compress. Every macro tailwind, dollar weakness, rate cut expectations, geopolitical instability, de-dollarization, is blowing in the same direction. 4 days from now, 429 million ounces of contractual demand meets 89 million ounces of physical supply. Remember where we started, those two numbers cannot coexist. The COMEX data is public. The delivery figures are public. The Shanghai premium is public. Everything I have laid out tonight, you can verify yourself. This is not noise. It is signal. And the people who check primary sources already understand why February 27th is not just another expiration date. It is the day the silver market has to show its hand, and the gap between what the paper says and what the vaults hold has never been wider.